Welcome to the Real Estate Education Investment Education Club. My name is Daniel Homlin. Today is November the 20th, and we have a couple of announcements before we get to our main speaker, Brian Brisco. And apologies if I didn't say your name exactly correctly. You can correct me when you introduce yourself.
Okay.
We have just a couple of announcements here today. First of all, we have a panel discussion, and for this panel discussion, we'd like to get Intel people that are involved in real estate syndication to be on the panel. We're looking for, 4 to 6 people, and they may even be involved in different aspects of real estate investment. But if you're interested in being on that panel, make sure that you contact me. The panel, I believe, is the second week of January. So we're going to try something a little bit different other than inviting a guest speaker in. We're going to have our own people speaking about their experience. Second of all, if you can see my screen right here, we have a couple of things that I want to highlight. First of all, our previous speakers list here is being redone. And I wanted to thank Meghna for doing that. She's putting a lot of effort into organizing the presentations and all the video recordings that we've done since September of last year. And so that's going to be much cleaner and put together in a nicer format so you can quickly find different topics. We also have our video recording section, which is on our videoportal.intel.com. You can go there and watch the video of anything that's been played previously in our club. And in addition, breakout groups. So we've had some feedback for breakout groups, and it looks like the 2 breakout groups that we're going to be creating are breakout groups around single-family rental homes, and then a breakout group around commercial real estate, which would include office space, medical, multifamily, gas stations, any commercial asset. So it looks like those are going to be our breakout groups. If you want to have a different breakout group, for instance, fix and flips, I did have, I think it was like 15% of the people were interested in that. If you really want another, topic, please let us know. Please go to Yammer. So here's our Yammer site. We've got 460 some people on this site. And people are having conversations here about real estate all the time. So check that out. One of the current topics that we're looking to get insight into is I've heard a lot of people are refinancing their homes. So, jump onto this thread and tell us if you refinanced your home, and tell us if you had a good experience with that person that's refinancing, or maybe you had a terrible experience and you want to point it out here. I'm also really curious about the fees that people paid in refinancing their home. I actually just refinanced my home last Saturday, and I got a 2.6% interest rate on a 15-year fixed. My fees were higher than I would like them to have been, and I've heard of people paying lower fees. So if you've had an experience recently, just drop into this conversation and share it with us. I believe those are all the announcements we have currently. Actually, let me go to meetup.intel.com and point out that we've listed a few more events here, and I don't have all the events here. We are currently booked out to March of next year. But coming up in 2 weeks, we're going to have our Arizona market report, where we have a real estate agent from Arizona coming in to talk about that particular market. For Brian's information, the 3 largest groups that are here are from, the largest is in Folsom, California. Second largest is Portland, Oregon. And then Santa Clara and the Silicon Valley area, and then Chandler, Oregon. Chandler might be our 3rd largest. But big concentrations there, and there are also people in this group from other locations as well. 96% of the people that attend have been in the United States.
Okay.
And so coming up next, in 3 weeks, we have Jason Hartman, the Creating Wealth podcast. He is a single-family home investor and runs a real estate network for people that invest in single-family homes. After that, we've got Shannon Roberts, who is a ground-up developer in Boise, Idaho. And then Kenny Wolf, who will be coming in to speak to us about triple net leases. And I promise you I will list the rest of our events here very shortly. With that, I want to turn it over to Brian. Brian, thank you for joining us, and just go ahead and introduce yourself.
Yeah, so as you said, Brian Brisco. Incidentally, my older brother is Jason Brisco. Why that's important is he used to work for Intel. His first job out of college, I think he was in the. He lived in Gilbert, Arizona. So is that close to Chandler? I'm guessing yes, but anyway, yeah. So anyway, there's a small chance, but some of you guys might know him. But from about 2002 to 2006, 2007, he worked for Intel. So. Anyway, that said, yeah, Brian Brisco. Let's see. I'm going to try to share my screen, see if this works.
Okay. And periodically, Brian, I'm going
Mm-hmm.
to hit mute all in case some people aren't muted. I think it's not going to mute you, but if
Mm-hmm.
it does, we'll fix it really quickly.
All right. So let's see. Um. All right. Can you guys see my PowerPoint yet?
It is loading.
It is loading. Okay.
Oh, and Brian, usually I monitor the chat room for the
Uh-huh.
speaker so they don't have to do that. And um, I want you to concentrate on your speech. And if there are questions that are pertinent, I'll just interrupt you and let them out, or we can keep them to the end of the meeting if you want.
Okay. Sounds good. All right. Now I'm not familiar with WebEx. I just lost all the screen. Can you guys see the PowerPoint?
It's on the left side of the screen and not maximized.
Okay. Now can you see? Okay. So I selected um, share the program, not share the screen. So how about now? Everything full screen?
Yes.
Yeah. Okay. All right. So yeah, first of all, Daniel told me that you guys had a fair amount of multifamily guys come on. So what I tried to do is instead of telling you the benefits of multifamily, which presumably a lot of you guys have heard over and over again, is maybe walk through kind of strategies to invest in multifamily and how to develop strategies. Hopefully I'll be able to do that in the next hour or so. We'll see. But one of my favorite quotes about real estate is right here. Will Rogers, actor, did a lot of country westerns, but don't wait to buy real estate. Buy real estate and wait. And a friend of mine shared a different quote with me on LinkedIn just today. It was actually about trees. He said the best time to plant a tree is 20 years ago. The second best time is now. I think it's the same thing with real estate. The best time to buy real estate would have been 20 years ago, but if you missed that, it's still true. Best time to buy real estate is probably now. So a little bit about me. I'll hit the right side first. Active duty Marine, retiring in November 2021, and that's significant in a couple of ways. It's basically 20 years after September 11th. Okay, so I was one of those guys that when September 11th happened, I was actually in a PhD program for math and decided to go active duty after September 11th. So did not go back to pursue a PhD. And interestingly enough, I have a letter in a file cabinet out in the garage from the University of Minnesota saying I could go back and enter that PhD program as soon as my tour with the Marines is done. So I think for kicks and giggles, sometime next year, I'm going to drive up to Minneapolis and see if they'll let me back in. But two master's degrees, one in math from the University of Utah and one in international affairs. Right now my role in the Marine Corps is I'm what's called a foreign area officer. So international affairs is what I do. And so I work at the Pentagon, and it's not as cool as it sounds, but it's what I do for the next little while. Left side of the screen, co-founder of Four Oaks Capital. I realized, when I moved to the DC area a couple of years ago that typically when they send us somewhere, we know how long we're going to be there. And I knew this was going to be a 3-year tour. And, I can do arithmetic. I showed up here with 17 years of service, and I kind of realized that, oh my gosh, this could be my last duty station in the Marine Corps. Right. So I started thinking of an exit plan. I'm like, well, if this is going to be my last duty station, I need to work on something else. All right. So up until then, I had picked up a handful of single family homes. Being active duty, one of the easiest ways to invest in real estate is just to buy every time you move. You move every 2 to 3 years, you pick up another home, you move, and you rent it out. So that was our investment strategy prior to. At one point, I realized that I wasn't scaling nearly as fast as I wanted to. I wasn't getting the cash flow that I wanted. And quite honestly, I didn't put a lot of effort into projecting and doing a lot of hardcore analysis on the properties when I bought them. But when I started looking at exit plans and scaling and where my income was going to come from, I've always wanted to do something real estate related. Once I discounted being a math professor and decided that wasn't what I wanted to do. So I started looking at alternatives to just the single family, and I stumbled upon a book about multifamily, and the rest was history. So yeah, in the last 3 years, we purchased $12 million in assets in the southeastern United States. We have another just about $10 million worth of apartments under contract right now in South Carolina and Georgia. Okay, so and we'll talk a little bit about areas as well. But so really quickly, why would somebody want to invest in real estate? I think I love this picture. Granted, I stole every picture from Google or other people's presentations, but I think one of the riskiest financial situations is to have a single stream of income. We've seen in downturns, or we've seen in whenever a company goes through perilous times, people get let off. Okay, my brother was let off from Intel in around 2008. So it happens. And if you only have a single stream of income, in my opinion, that's one of the riskiest financial positions you could put yourself into. So why invest in real estate? Well, you look at the right side of the screen. Which one do you want to be? Which one should be indicative of what's going on financially? I would like these several streams of income flowing into a large pool instead of a single stream into a bucket. And real estate is just one way that you can do that. Okay. What advantages do real estate have? Well, there's a whole lot of them. I'll briefly touch this, once again, assuming that, every other multifamily guy or every other real estate, person has talked about a lot of these before. All right. But, first one's leverage, and one thing that I love, especially being with my math background is the fact that you can get leverage on a property. You can't go to the bank and say, I want to buy $1 million in stock. Will you give me $800,000 to do it? All right. But you can do that for real estate. And obviously, if you've got, 25% down in real estate, and a property appreciates by, let's just say 10% over a period of time, you're not earning 10%, you're earning 10% times 4 on your investment because of the leverage, so because you can go to a bank and a bank will put a large portion of the purchase price down, your returns are amplified. Now, conversely, if you lose money, it's also amplified, but anyway, we try to do the best we can to mitigate those risks and go along with it. Next thing is appreciation, and appreciation and leverage go hand in hand. There's a target inflation rate for the United States the Fed sets, usually around 2%. And Fed's recently come out and said, well, maybe 2% can be an average instead of a yearly thing. So we may see some more inflation in the next couple of years, 2 to 3% inflation. But rents go up with appreciation, and property values go up with appreciation. So, when you combine the two together, owning real estate over several years is typically going to come with a fair rate of return on it. All right. Now, income tax is another thing. Currently, real estate is very friendly tax-wise. With the new administration, there's going to be a couple of things that may change that, but there's still a lot of things that are, make real estate very tax advantaged. One of that is depreciation. You can still depreciate real estate, and I don't think the Biden-Harris tax plan has anything to do with taking away depreciation, but it is still going to be a tax advantaged way to earn money. And then the middle one, forced appreciation. So not only is there gradual appreciation with inflation, but you can put some money in the right spots and be able to push the value of real estate up. We see this in fix and flipping all the time, but guess what? You can do the same thing with apartments. You can put a little bit of money in. You can raise some rents. Make things nicer for the tenants and force the value up. And then the last one is cash flow. You can earn a solid return on your money from income minus expenses equals profit, and that profit gets distributed among owners. So lots of reasons to invest in real estate. Once again, assuming that most people in this forum are familiar with those. All right, but one thing I'd like to ask is what are your goals for investing in real estate? And when you're looking at real estate investing strategies, I think this really should be your first question. What are your goals? What are you trying to get at? Like Stephen Habby's 7 Habits book, one of the habits is begin with the end in mind. Okay, so do you want to be ridiculously wealthy, own a yacht, and or are you just looking at maybe retiring at age 60 or so and wanting to live your golden years in comfort? So whatever your goals are, it's for each person to determine, but your investing strategy is going to be a method to help you to achieve the goals. So begin with the end in mind, and that's going to potentially lead you to one investing strategy over another. All right. And most of what's on this page, I should have flipped this slide a little bit ago, but end of the day, we're going to talk a little bit about some of the things you should think about when building your strategy. All right. So the returns are important, and there's lots of different ways to get returns on real estate. Okay. Some projects are going to be heavy on the cash flow, and some projects are going to be heavy on the appreciation. Okay. If you're in California and you're buying a rental property and you're expecting it to cash flow, good luck for all of you guys in California. I think you guys probably understand what I'm talking about. I bought my second investment property was in San Diego County. It's actually the city of San Diego still. And we bought it in late 2008 after the crash. We thought we had a steal on it. When we started renting it out, it wasn't even cash flowing, So there's some places that are better for cash flow, some places that are better for appreciation, some places that give you a little bit of both. But it's something you just need to keep in mind when you're investing is, what are you looking to get? Are you looking to build wealth, or are you looking for cash flow? Okay. And I think my personal opinion, the younger you are, the wealth building is probably going to be the more important. If you're looking to live off the returns off of your investments, then the cash flow portion is different. But just realize that the returns are going to come from two different pots. Either the cash flow while you own the property, or the equity that accrues in the property over time. All right. Something else to look at when you're building your strategy is just the timeline. When do you need the returns? And also, you just have to realize that real estate investments are not liquid. It's not like a stock exchange where you can, buy or sell stocks any day of the week almost, or business days. But it's an illiquid investment. So when you put your money into real estate, it's not fungible. It's not something you can easily, recoup those dollars invested. And then the last thing, I think anybody should look at is just risk tolerance. There are some investment methods that have a higher risk profile than others. And we'll talk a little bit about some of those. Something else you want to look at is capital preservation and certainty of returns. So and typical with other investments, the higher reward tends to come with a little higher risk. All right, and the capital preservation, certain returns tend to come with a little lower rewards and lower risk. So real estate in general, there's different types of commercial real estate, multifamily, office, industrial, retail, hotel, and leisure. Okay. I focus on multifamily for a lot of reasons. And typically, one of the reasons I focus in multifamily is because of the resiliency. Okay. So this is a graph from CBRE, which is one of the biggest lenders in the space. And basically, this is the recession in end of 2001, basically what happened. So what you're seeing is the light blue is where real estate went down, or where each particular asset class went down. The light green is a growth period, and the dark green is a growth period. So the light green is how long it took to get back to where it was pre-crash, and the dark green is growth past the prior peak. So if you look at this, you look at the different asset classes, you realize that out of what's shown here, multifamily recovered the quickest. It was affected for the least amount of time, and it recovered the quickest. All right, fast forward to 2008, and you see the same thing. Multifamily is on the top, five months of negative quarters, I think. Is this month or quarters? This is quarters. 5 quarters of negative growth trends. 7 quarters of growth to reach its peak, and then a lot of growth after that. So, when you're looking at the different investment philosophies, I like multifamily because of the resilience. And something that I always come back to when talking about this is, why is multifamily resilient? Because everybody needs a place to live, and that's just a fact. It's a basic human need. We all need shelter, and there's a large segment of our population that are not renters by choice. And we'll get into that a little bit more when we get into asset classes. But there's a large, like the workforce population, are not renters by choice. They're renters by necessity, which means they're going to keep on paying their rents as long as they possibly can to keep the roof over their head. All right, now here's another survey. This is more recent, also from CBRE. It's basically, coming out of this recession, what people think about the current asset classes. And this particular recession ended up hurting office and retail a lot more. And because of your Amazon big box store, your Amazons, your deliveries, services, and things like that, industrial actually did a lot better. But once again, multifamily is very resilient. So when you're looking into multifamily, you're going to, I look at it as kind of a hedge against inflation, or not inflation, recessions as a little bit, because, other asset classes may fare better or more poorly. If you look back at the other ones, in 2008, industrial did not do very well. And in 2002, industrial also did not very well. So anyway, all right, disclaimer, I'm a multifamily guy, so I'm going to tell you multifamily is great. Just understand that, okay? All right, a couple factors to look at when looking at your strategy. There's a market size and there's risks involved both directions. Asset class, we'll talk about that. Geographies and kind of value add strategies. Okay, but first thing we're going to talk about is forcing the appreciation. Doing like a value add proposition. So basically, with a value add, there's a couple ways to do it. You can come in and you can make operations more efficient, or you can do some renovations. Okay, both are going to add value to the property. Okay, and we do value adds on exteriors as well as interiors. Okay, so you can spruce things up on the outside, improve curb appeal. You can make things nicer on the inside. But end of the day, you're looking to do the same thing. Okay, in the bottom right of this slide, you can see my cursor moving around. This is one of the ways to value commercial real estate. Okay, the value of commercial real estate is equal to the net operating income, which is all your income minus all of your expenses except for debt, divided by a market cap rate. Okay, the cap rate is something that you can't control directly, but you can absolutely control the net operating income. So the goal with a value add is to increase the net operating income. And if you increase the net operating income, you're increasing the value of the asset. So if you can come in and, for $5,000 or $10,000 per unit, increase the monthly rents by $100 or $200, that's going to have a much larger effect on the overall value of the property. Okay, so the goal is to increase that net operating income. You can improve management, you can reduce the vacancies, you can bring the rents up to market rates. Those are all operational in nature, but you can also do the renovations. Okay, so end of the day, increasing rents, decreasing expenses is the goal. And number one, you're going to increase the cash flow by doing this, but you're also going to increase the value, which when you sell is going to increase your bottom line. So some of the things with a value add, one of the pros is you're not dependent, and this is key when we're talking about risk. And when an investing group like ours puts together a pro forma and a pitch deck and everything else, we are going to forecast what future rents look like. Okay, and most people, when they do this, are expecting rents to go up year over year. And they're expecting to be able to sell at a higher price than they buy. And that's been true in real estate for, decades, except for, certain periods. But for the most part, they're expecting that to happen. All right. But when you're doing a value add, you're not dependent on future growth. Okay. And I just saw a question pop up, and I'm going to answer that one. But the question was, how can you tell how much your rents can go up with a value add? The answer is the second bullet. You can look at the comparable properties. So if you're buying a property that's surrounded by 3 or 4 other apartment complexes, you look to the left and to the right and to the north and to the south. You compare features, you compare amenities, you compare square footage. You compare everything with the properties, and you can come up with a value that your rents will be post renovations. So if current rents at a property are $800 and the neighboring property, the rents are $1,000, you look at the features and say, well, the neighboring property has the same size apartments. They have, roughly the same floor plans. It's just a lot nicer. Then you can bet that if you bring the $800 per unit property up to the same condition as a $1,000 per month property that's, half a mile away, that you should be able to get roughly the same amount of rents. Okay, so it's not dependent on future growth. You do still have to do your homework though. But in my opinion, when you start basing your returns off of future growth, you don't know if that growth is going to be there or not. So the more, the higher the percentage of returns is based off future growth, the more risk that's involved with a particular property. Okay. So like I say, with the value add, one other pro to that is you're receiving rent while you're doing the value add. Okay. We'll talk about repositions next, but that we'll compare and contrast those. But the cons is, you're going to come in with a large renovation budget, which means you're going to raise a lot more money than the current property value. So, for example, we are in the middle of, I'll tell you about a property we just purchased. Paid $3.5 million for a property, and we have a $1.2 million renovation budget. So all in and then you include our closing costs, all in, we were just under $5 million. The property is currently worth 3.5. Okay. So there is a little bit of risk involved. There's more risk involved in a value add than there is in just buying a property and letting it cash flow. Okay. Because if we don't do the renovations correctly, if we're not able to hit our marks, if we're not able to do everything, there's a portion of the investor's capital that is at risk. So anytime you're raising a lot more than the current value, there's a risk to lose capital. Now, if you do it right and you're looking at all the comps, you can mitigate those risks just by doing a lot of homework. And I saw another chat pop up. there's lots of sites. Reonomy is one. I like apartments.com. It has a lot of pictures on the inside and the outside as well. So anyway, there's lots of ways to come up with it, and there's lots of big data sources that can really help you with this. So next we'll talk about a reposition. A reposition is a little bit more than just a light value add. Okay, this is a building in Spartanburg, South Carolina. We have 2 properties that are about a mile away from this. Okay, Spartanburg is nicknamed Hub City because a lot of railroads used to meet. A lot of the East Coast railroads used to meet, and they actually still do meet in Spartanburg. Okay, so this building used to be a warehouse. And they took a warehouse, they put a lot of money into it, and they converted it into A-class apartment buildings. Okay. Heavy reposition, so just a different way of forcing the appreciation on this one. All right. Now, pros and cons to this one, once again, you're not dependent on future growth in rents again. Okay, so you're taking something that was meant to be a warehouse or an office building or retail or something else, and you're converting it into apartments. So you can look at the apartments in the area, you can look at the supply and demand, and you can project, okay, these are the rents we'll be able to command when we bring this online. Okay, and there is a little bit of future rents in there when you're doing the analysis, but anyway, you can usually buy pretty cheaply. A warehouse in a downtown area that's not being used, you can buy that pretty cheap, and then there's a significant amount of money that goes in, which is going to be on the con side. Now, this could be a pro or a con. Usually the short hold time, 1 to 3 years, however long it takes to reposition. Usually the people who reposition are ready to exit at the end. They're not going to want a cash flow. So your money would only be tied up for a couple of years in this case. But these usually have large renovation budgets. And you go back a slide or two, we said a light value add, and these are my definitions of light and medium. 5 to 10,000 per unit is about what we're putting in a lot of the properties we own. This one, we're talking 30 to 40,000 per unit, and sometimes more to bring these units online. All right. So when the investment group is raising money, they're going to raise a significant amount more than the current property value, which makes it a more risky position. So there is a chance that investors lose money. And another thing is they do not have income coming in like you would in a lesser value add proposition. For example, when we're doing value add, we're keeping our occupancy level 85 and above. So we're still getting, monthly checks from the current residents that are paying all of our expenses. When you're doing a heavy rate reposition, you're not going to get that type of income. So there's a little bit more there. And I don't have a slide on this one, but if I were to take this one step further, I would add development next. Development is very similar to a heavy reposition, but there's a little bit more zoning and everything else involved. But the pros and cons roughly align with a development than it does with a heavy reposition. Incidentally, the last property we closed on, we were actually the beneficiaries of somebody who was going to do a heavy reposition. Property is about 2 miles from Clemson University in central South Carolina. And the previous owner bought the apartment complex. It's a C class. We'll talk about classes in a second, but it was a 1970s build apartment complex that they were going to bulldoze, and they were going to build brand new student housing over it. It was going to be a very heavy reposition project. Now, what happened is the county put a moratorium on new building because the utilities and the road networks and everything else hadn't caught up with the previous growth. So they bought this place, wanting to do a heavy reposition, held it for a couple of years, and just decided, okay, the moratorium's not being lifted. Now we have this COVID thing, and they ended up offloading it. So we got a screaming deal on it, and we're going to do a heavy value add on it. We're doing about 12 to 15,000 per door on this one. But end of the day, you can see some of the risk involved. There's zoning, there's building permits, and a lot of other things that you don't necessarily have to have on some of your value adds. I mean, we do have to pull permits on some things we do, but not on others. All right. And Daniel, I'm going to switch from value add to geography. Is there any questions that were dropped in there?
Sorry, I'm on mute. Yeah, we've got
Okay.
one question that's here. It's from Andrew. He says, "Hi, Brian. How do you assess a market to determine that there will be enough demand for a post-renovation unit post-renovation unit rental rates that you project?"
There's a lot of big data out there, so like Yardi and CoStar. There's a lot of companies that collect these data. So Yardi does property management, but they have the benefit of lots of property managers use their software, so they can actually collect a lot of data on it. So Yardi will put out reports on certain markets. CBRE, which is a lending institution, will aggregate data from all the stuff that they have. And when you get a loan, you have to give quarterly financials to the lender. Just one of the things you have to do. So they have tons of data they can sift through, and so they're tracking things like your vacancy rates. They're tracking things by region, by neighborhood in a lot of cases. So you look a lot at the data, and then you can go off and you look at population growth. You can look at job growth. You can look at a lot of these data sources. So what we're looking for are areas where the population has been increasing and is expected to increase. We're looking for areas where job growth is present and is expected to continue. And one thing that is very indicative on the supply and demand is the median home price. Okay, what's happened to the median home price in the last 5 or 8 or 10 years? Okay, if the median home price is flat, then there's not a supply and demand imbalance. If the median home price has doubled in the last 10 years or the last 15 years, then you can look at that and say there's definitely a supply and demand imbalance, and you want to capitalize on that. So the answer is you look at your really big data sources, and then you get a boots on the ground view of things. Your property managers are really good data sources for what's happening at neighborhood levels or at city levels. So just a combination of every source that you can find on that.
Do you mind if I add a comment there, Brian?
Absolutely. No,
Sure.
I don't mind. Absolutely add it.
Yeah. So, and you mentioned it right at the end too. Property managers is a good way of doing that. When you're looking to do due diligence on an apartment complex, you have your whole team fly there, and you meet your property managers there on the property. And you usually want to partner with a property manager that's got several hundred units or maybe 1,000 or 2,000 units in that market. And that way you can ask them what's going on your other properties. And do you think that the rents here are going to match the rents over in your other properties? So just having boots on the ground and people you can talk to that have experience in the area is a good way of rating that as well.
Yeah. And you grow experience in certain areas too. There's a lot of things, we have we have 5 properties in upstate South Carolina right now. And I can tell you what the average water bill is in upstate South Carolina, what the average rent for C-class, so there's a lot of things that you start learning as well, just by being in a market for a long time. But, the property managers, they're living and breathing it, I'm looking at financials from 500 miles away. But incidentally, 3 of my 4 partners are in the Carolinas. That's where they live, and that's what they call home. But speaking of geography, hey, guess what? It matters. And the byline right here, I put maximize your natural appreciation. Did I have I thought I had a sailboat picture in here. Where's my sailboat? Oh, there it is. Okay. Yeah. All right. So I look at geography as, a tailwind. Okay. So if you're looking on that or if you're looking at that appreciation, that leverage, if you buy in the right place, it's like, being on a sailboat with the wind blowing in the direction you want to go. Now, if you know anything about sailing, you can still sail upwind. It's just you have to tack, and it's a lot slower. Okay, it's a process for it. At the end of the day, I think geography does definitely matter. So, just a couple of things right here. Different metrics on what states are doing well and what states aren't. Okay. The map on the left is U-Haul data. Okay, based on where U-Haul trucks are going. Okay, green are the cities that are getting the most people coming in. Red are the cities that are getting most people moving out. All right. You notice there's a lot of red in California. On the West Coast, there's a whole lot of red. All right. On the Northeast, there's a whole lot of red. And in the South and the Southeast, there's a lot of green. Okay. And the next one is aggregate IRS data. Where is the money going? So left is where people are going, right is where money's going. And you can kind of see, same thing. Red states are the states that are losing money, aggregate from IRS data, and the green states are the ones that are gaining money. Okay, so we know where people are going. We know where the money's going, and so we invest in the Southeast. Okay, you look at all these green dots over here. You look at all of these green states over here, and that's where we're investing. Now, part of the reason we invest there is my wife was born and raised in South Carolina. Okay, so we know the area well. We've got a lot of relatives there. I don't have to pay for lodging when I go to South Carolina. I just pick a relative, call them up and stay with them. But we've lived in South Carolina, North Carolina, and Virginia, so we know the Southeast fairly well. Now, the next thing here is, a census report, 2014 to 2018, of the fastest growing cities. And once again, the color code, 1 through 10 is green, 11 through 20 is blue, 21 through 25 is yellow. But once again, what you're seeing is, the Southeast is where a lot of this growth is. And Texas is also a pretty hot market. And then you've got, a Boise, you've got a Vegas, you've got Colorado, Portland. On the previous map, my hometown, Salt Lake City, was one of them on the U-Haul map as well. So you start looking at what's happening demographically. I'm going to go back to this one right here. Typically, what's happening is a lot of your West Coast money is moving into the Intermountain West. Okay, and the Midwest and Texas are also the recipients of a lot of that money moving in from the higher cost of living areas. In general, money is moving from higher cost of living to lower cost of living, and from colder states to warmer states. So on the East Coast, it's basically moving from north to south. So that's where people with money are going, and I'll tell you what, I'm going to retire in Idaho. That's where my wife's family ended up settling, her mom and sisters. But home prices there have gone up tremendously. And everybody is talking about the California money. And most of you guys are in California, so you understand what that is. You live in a place for 10 years, your home value goes up by $200,000-$300,000. You're looking for a better place to live, lower cost of living, where you get more bang for your buck. And you sell your house, you release that $200,000-$300,000 in equity, and you can go buy a really, really big place in Salt Lake City or Idaho. And that's driving property prices up. So the net migration is going from higher cost of living to lower cost of living. All right. Now, something else to look at is, in real estate, primary markets, secondary markets, and tertiary markets. Now, there's not a real hard and fast definition of what a primary market is. In general, it's the cities with 5 million and above. Okay, those are automatically primary markets. But cities with this is what lenders use to determine rates and terms. But they're also looking at volume. Okay, so lenders are looking at volume of sales. So maybe a $2 million market or 2 million population market that has a lot of real estate activity would be a primary market, like Charlotte is, or like Atlanta. Neither one of those cities are primary by population, but we kind of look at investment strategies in this place. Okay, there's some pros to primary markets. Okay, as far as lending, you're going to get better terms and better rates. Okay, primary markets have a more stable economy. I'm a military guy. I've lived in some very small military towns, and I've seen what happened. 2010, 2011, there was a drawdown in the military when the president took us out of Iraq. There was a corresponding, well, we don't need as many troops. And I saw a small town of Havelock, North Carolina, just crumble because the workforce dried up. So what you're looking for, what you get in a primary market is a very diverse economy so that one sector isn't dominant. All right. So military drawdown isn't going to affect Dallas as much, or big company going out of business isn't going to affect these larger cities. And primary markets now, high growth, primary markets tend to do well in upturns and not so well in downturns. And we're seeing that right now with COVID as well. All right. The cons to primary markets is the higher prices, higher competition, and less cash flow, which is what you get in New York City, what you get in Los Angeles. Okay. It's really difficult to cash flow if you're only putting 25% down, So the primary markets have been viewed as being lower risk, lower returns. But actually what we've seen during COVID is the primary markets are where multifamily is doing the worst. Secondary markets are slightly smaller. You're still getting decent rates in terms, if you're comparing the primary, you're getting decent rates in terms from the bank. You're not going to get the best interest rates, but you're not going to get bad interest rates. Generally, there's lower prices and less competition. So one of the strategies that we have is we don't look in primary markets. We're looking in the smaller secondary markets. All right. So upstate South Carolina has a population, the MSA has a population of about 1 million. All right. We like Augusta, Georgia. Okay. Collectively has a population of about 1 million. So we're looking at the smaller secondary markets because the prices are lower. There's less competition. They're still fairly stable. They still have diverse economies. And you can get a lot of the growth that you see in primary markets that you don't, that you may not see in like the tertiary markets. Okay. And tertiary markets are smaller. Some of these are just, one horse towns, so they're smaller. I would say if you want to invest in a tertiary market, you need to know the area like the back of your hand, because there's a much smaller population. You're not going to have vendors. You're not going to have property managers. You're not going to have a lot of construction firms to choose from to do your value add. Just a whole different beast. A little bit more risk associated with that. All right. So let's see. Check my time. Whoa! I need to hurry up. All right, asset classes. So A class, brand new, bells and whistles. Okay, you got the pools, you got the fitness centers. Okay, B class, a little bit older, not as many amenities. All right, C class is your general workforce housing, think 20 to 30 years old. And D class are places that you don't want to go at night. Okay, some of them are places you don't want to go during the day. Okay, compare and contrast really quickly. The A class, you can't force appreciation with A class. It's hard to make them better because they're brand new. They have all the amenities, and they're typically managed pretty well. They typically have more appreciation during good times, and the cash flow is a little bit low. All right. C class is what we like because they're a little bit older, and you can generally find a C class asset that hasn't been renovated in 10 or 15 years. You can go in, make some improvements, and push that appreciation up, the forced appreciation. They don't appreciate nearly well as A class, and they typically cash flow about the same or better than A class. And B class is somewhere in between A class and C class. All right, so different risk versus reward profile when you do it. And D class, personally, I recommend staying away from it, but D class will typically have quite a bit of cash flow if you do it right. But there's a lot of other problems that go with it that bring a lot of additional risk, a lot of crime, a lot of drugs. And interest, not your interest rates are going to be higher, and your insurance rates are going to skyrocket for D class. But there are people who do make money in that asset class. All right, now looking at risks, A class is typically the first to lose in recessions. Most of your A class returns are dependent on appreciation, and there's discretionary tenants. They don't have to live there. Is what that means. So in a recession, they can move. They can buy a house. They can, and a lot of them will move down to B class or C class if they're priced out of their, if they lose a job or their income's cut. So they can move to a B class. They can move to a C class. don't know why I didn't put the little risk things on there, but it didn't update that slide completely. So ignore that part. But with C class, you tend to have a little bit more delinquency. Your tenants are not as high paid as far as professions. Their credit may not be as good as the A class tenants, and the appreciation rates aren't as high. So it's just something that you have to look at when you're evaluating properties. There is definitely risk involved. In D class, like I said, there's lots of risk. Are tenants paying? Do you have to go knock on the door every week or every month to collect rents in D class? And that's really what D class are. I think with C class, you still have moderate amounts of delinquency. Most people are good people who are working, blue collar jobs, decent workforce jobs that want to live in a nice place, and they pay their rent every single month. So once again, that's one reason we like C class, and that's it. So any questions? I saw a bunch of things pop up. Daniel, is there anything to highlight from the asset class portion? And you are muted right now if you're trying to talk.
Thank you.
Yeah.
A really quick question, and then we'll let you give your contact information before we have to close the meeting. But what is an acceptable credit score on the low end for C class?
Mid 600s is kind of what 600 and above is kind of what we're looking at. And there's a little bit of play, a little bit of wiggle with that. The lower we will take lower, but we'll usually ask them for a higher deposit up front. So and we'll also look at reasons why. So if somebody who had a foreclosure 5 years ago and it's still on their record, it's not there's not a hard and fast on this one, but for the most part, 650 is about what we're looking at for credit scores.
And then the second question is, how do you identify a property that belongs to a D class?
Just look at the high crime areas. Generally, high crime and old. It's one of those things that you can kind of feel it. If you look into a property and it's run down and it's just not a neighborhood that you feel comfortable in. I've grew up in nicer neighborhoods my whole life, but it's probably a D class.
All right. And no other questions at this point. You can keep going for 3 more minutes or skip to COVID's always an interesting topic, but do give your contact info out.
Okay. So let's see. I've already talked about my investment philosophy. So with COVID, what we've seen, primary markets and A class have been hit the hardest. Okay. C class have fared pretty well overall, and it's also regionally dependent. So basically, what we've seen with COVID is vacancy's gone up by a couple of percentage points. Nothing major. Collections have gone down by a couple percentage points. Nothing major. Okay, so for C class apartments, most C class are doing well. And if you remember that heat map from up front, the areas that were doing well pre-COVID are still doing okay. Most of the red areas on that heat map were the ones that have been affected by COVID. And then general thoughts, as I said before, if the returns are based on future growth, there's a little more risk involved. All right. Repositions and ground up construction typically will bring the highest returns, but once again, there is substantial risk because of the high capital requirement. And in my mind, cash flow is still key. But talk about the investment philosophy, but there's my contact information. Like Daniel, I also have a podcast. He's been on mine. I've been on his. And so if you're interested in podcasts, it's at the bottom. And all my contact information. So reach out to me if this is something you're interested in, you want to talk more, and be happy to take your call. Happy to answer any emails.
All right, Brian, thank you so much for coming in and presenting to us. And if anybody wants to reach out to him, feel free to do so. Thank you all for being here. We're going to reconvene again in 2 weeks. So thank you very much.
All right.
Thanks, Ben. Thanks, Daniel.
Thank you, Brian.
All right. Thanks a lot. Appreciate it. Yeah.
Let's catch up again sometime soon.
Yeah, let's do it. We're overdue, so sounds good. All right. Well, I'll
right.
log off. I got another call right now anyway, so about that time.
All right, and I'll end the meeting in about 2 minutes or so. Let people chat and then log off.
All right, perfect. Thanks. I can figure out how to log off. This
A
is
little
not
X down at the
Zoom.
bottom.
Down at the bottom. Oh, that's okay. Hold on. I might have to stop sharing first. Okay, I see it now. All right. Thanks, everybody.